Good morning, everyone. I'm Martha Stokes. I'm a chartered market technician. I love to teach and help traders learn how to be semi-professionals and actually make a very good living in the market. There's far more to the market than day trading and that type of thing, and I like to introduce different concepts. Today, we're going to talk about what happened here and why it went down in reality rather than what the fictional retail news is telling everybody. Oh, Wall Street hated this or whatever. Yeah, get rid of that stuff. It doesn't help you understand. You have to understand what is going on and why it's going on and what is happening. I'm using the SPY because it is a very heavily traded ETF, the most traded one in the entire world, the original ETF. And so it also reflects the action of the S&P 500. Now, some data you need to know. This was not a major sell-off. This was a void of buyers. So who was the buyer? Who was the buyer that suddenly stopped or slowed down or decreased their accumulation or their buying patterns or whatever they were doing? Who was that market participant group? Who was the market participant group that kept nudging this, the S&P 500 and the NASDAQ? They all have similar patterns, and the Dow nudging it up, pushing it up, pushing it up. All the Fortune 500 companies. Who is doing that? Is it retail investors? No. Is it smaller funds? No. Is it buy-side institutions? Buy-side institutions buy down here. They do not buy up here. They hold. And as we can see this, if I go to a weekly chart, which I'll do shortly, there is a bending of this curve as the buy-side institutions were lowering inventory on many of the S&P 500 stocks and NASDAQ stocks in September, which they always do in September. So put it on your notepad or whatever and say, in September, dark pools, buy-side institutions will be rotating and lowering inventory on major component index companies. And this will usually or often bend the pattern. So if we just quickly go to the weekly chart, we can see the bending pattern. Whoa, look at that. Wow, isn't that amazing? Yeah, and that because they're slowly rotating out. So who the heck was buying this? Well, 436 of the S&P 500 companies are doing open-ended buybacks. I did a whole lot of research and I studied all the stocks and I did individual stocks. I go, well, they are supporting their own individual stock because they want to keep the market cap up. They want to be able to provide good dividends in an earnings season that may not be that great for some of them. It will be good for others. There's a lot of projections out already. The retail analysts have had their say. I don't listen to the retail analysts because they're clueless, and you should consider not listening to them either. You can see it in the stock charts and you can check and see what's going on. So we have this bending pattern. So the corporations have been pushing price up on the S&P 500 for their own individual company by doing buybacks. And you can see it on all their charts. I'll show you one in a little bit that was going on later this week because I want to share with this. So all of a sudden, guess what happens? We have an earnings season coming. We have a lot of strife and stress and all kinds of news that's negative, da, 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 da. But the corporations aren't paying any attention to this. So this whole activity going in September, all the things that have been going on, they're doing buybacks to boost their stock price, to keep their market cap up. That's the only reason they're doing it. Plus, dividends and earnings and so on and so forth. Well, before they can report their earnings for quarter three, they have to pause their buybacks because they can't be overly influential of the price of their stock during an earnings season. It's against the rules. So they start pausing their orders, and all of a sudden, there are no buyback orders on 436 different companies. So we have a void of buyers, and the void happened from the corporations. It is not Wall Street driving price down or every retailer running to sell their stocks. No, the first thing that happens when something like this falls down comes all of a sudden, and retail investors who don't use charts and retail traders who don't understand charts think, oh my, and they don't do anything because they are in shock. A lot of people didn't find out about this because they're out living their lives, and they're not paying attention to the stock market every single day like you are. And so the shock came over the weekend when they heard it on their Amazon, or when they heard it on their phone, or got a little notice on the weekend. Oh my gosh. So there are two kinds of retail and small funds managers, that how they're going to react. This is a bounce. This is not the end of the downtrend. This is a bounce. And why did a bounce occur? Because all these AAII and IBD and all these other long-term investors have been told to buy on the dip. And before this, they were told that the market was overextended and it needed to correct. So now they're buying on the dip. But the downside is not over yet, because the dark pools have not come in, and we only had a 2.7% decline. That is a minor decline, even though it looks like a really big decline because of the void of buyers. So now with the bounce up, we're going to have, probably in a day or two, sell on the bounce. Retail investors and smaller funds managers in particular, because now all of a sudden all of their customers and clients are terrified, and they want their money back because they're being told that we're going into a Great Depression, or we're going to have a huge market crash like we did in 1929, and this pattern won't support that issue. If we go to weekly chart, we can see that yes, it's curving, but it is not a straight up vertical rise like there was for the 1929. Plus, it's a completely different market. There was no SEC, there was no rules or regulations. There were just big banks being stupid, buying a whole lot of real estate and lost a lot of money, crashed and burned. It was speculative. It was just like the NASDAQ 100 that went up vertically in between 1990 and 2000 and couldn't sustain the tech bubble. It was a technology bubble. This is not a technology bubble, folks. Look at this on the monthly scale. So we have a little buying going on by corporations, and buying going on. Yeah, it's going to correct, but how far can it go? Well, folks, we have support way above the bear market call of 20% and going lower. So you need to understand this stuff, because you're probably trying to figure out how to trade this market. Do I sell it short? You're going to get into some activity here. And of course, the sell side institutions are the market makers. They're selling short. They've made a lot of money on Friday, and they are planning on making more money. So it'll probably support right here, and they'll do their buy to covers, but most of their buy to covers are going to be down here, still well above the 20% decline of a bear market call. And they know this because they are afraid that if the market goes down like this, buy side institutions push the price up. Oh, more sellers come in. Oh, great. Let's buy the stock and push it up even further. And pro traders get in. And then there's some speculation going on with HFTs and other groups. And so it's dicey, and they keep trying to put, everybody's selling when they should be buying. And then, of course, it runs right back up and resumes the uptrend. We could have a crash down to here. It's not a crash, it's just a correction. And we could have it a little bit lower, but at this point, there's not enough unknown black swan event thing happening, because the news is all out there blathering all the time about all this stuff. And so everybody's getting prepared, but a lot of people will hesitate. As long as the 401k owners hold and just wait this out, and they've been told, buy and hold, buy and hold, buy and hold. So they're going to buy and hold as long as it doesn't go into the 20% bear market. And guess what, folks? We're going to have a 20% that pops in, with the buy side institutions sitting and waiting patiently for bargain price stocks at or around the 20% mark. So they're going to move in and push the price back up, because there is nothing seriously wrong. There's a lot of chit chat and there's a lot of concerns and everything, but our institutions are strong. They're run by brilliant dictators called CEOs, and they are not afraid of anything. And they will hold the line. You have, as soon as the earnings are released and everything is settled out, the corporations will continue to buy back. As soon as the stock market starts heading toward that 20% bear line, buy-side institutions are going to start propping it up. Why? Because they want their 401k holders to hold, hold, hold. And that's what they do. This is not anything like the bear market of 1929. So don't believe that garbage. I'm Martha Stokes, and I will see you later because I have more to talk about. Thank you for joining me today.